Hey everyone, welcome back to Corporate Decoder, the place where we tear apart financial filings to see if a company is actually making bank or just spinning its wheels, or maybe something a bit more complex. Today we are diving into Bank of Marin Bancorp latest quarterly report, and let me tell you, it has some very interesting moves and numbers to unpack. This is their Q3 report for 2025, and they are reporting to the SEC, which is like the government's watchdog for public companies. This report tells us how the company is doing financially for the 3 months ending the 30th of September 2025. And if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we talk more about these kinds of reports. Alright, let's pull back the curtain on their financial statements. First up, their balance sheet as of the 30th of September 2025. They have total assets of over $3.8 billion. That is a pretty big number. Their loans, which are basically money they've lent out, are worth over $2 billion after accounting for potential losses. That is a core part of any bank's business. And their total assets grew from about $3.7 billion at the end of 2024 to $3.8 billion by September 2025. That's good growth. On the other side of the coin, their liabilities and equity, deposits are their biggest liability, meaning money customers have in the bank. They have over $3.3 billion in deposits, which is a significant increase from $3.2 billion at the end of last year. This shows customers are still trusting them with their money. Now let's talk about their equity. Retained earnings, which is basically the profit they've kept over time, is over $241 million. That is a healthy chunk of their equity. Overall, their financial condition looks solid with growth in assets and deposits. Moving on to their income statement, which shows how much money they made or lost. For the third quarter of 2025, they reported a net income of over $7.5 million. That's a welcome change from a loss of $8.5 million in the previous quarter. And for the first 9 months of the year, they made about $3.9 million. You know, the big story here is that big jump from a loss to a profit. This tells us they are becoming more profitable. The loss in the second quarter was mainly due to selling a bunch of investment securities at a loss to reposition their portfolio, and hopefully make more money in the long run. They sold about $18.7 million worth of these securities. If you take that loss out, their underlying business actually performed quite well. This section of non-interest income is a bit of a roller coaster. In the third quarter, it was $2.7 million, but in the second quarter, it was a negative $15.6 million. That's because of those investment security sales we just talked about. They strategically took a hit to reposition their investments, hoping for better returns later. Now, expenses for the third quarter. Their non-interest expenses were about $21.3 million, which is pretty stable compared to the previous quarter. For the first 9 months of the year, expenses were around $64 million. The biggest chunk of that is salaries and benefits. They spent a bit more on salaries and benefits this year, which makes sense as they grow. Looking at changes in stockholders' equity, we see how their ownership value is shifting. They paid out dividends to shareholders, which is always good to see. They also repurchased some of their own stock, about $3.3 million worth in the first 9 months of 2025. This can be a smart move as it can increase the value of the remaining shares. The cash flow statement shows where their cash came from and where it went. For the first 9 months of 2025, they generated a good amount of cash from operations, about $25.5 million. They used a lot of cash though in investing activities, nearly $90.5 million, which was mainly for buying those investment securities. They spent over $421 million on buying investment securities in the first 9 months of 2025. This tells us they are actively managing their investment portfolio, buying and selling to optimize their returns. There are a lot of adjustments on this statement, but one that stands out is the amortization of investment security premiums, which was about $666,000. This is just an accounting adjustment for how they value their investments over time. Now, for perhaps the most crucial part for a bank, the allowance for credit losses. This is money set aside for loans that might not get paid back. For the third quarter and the first 6 months of 2025, they recorded $0 for this provision. That is fantastic news, suggesting they are very confident about the quality of their loans. This contrasts sharply with the first 9 months of 2024, where they had to set aside $5.5 million for potential loan losses. This significant drop in the provision for credit losses is a strong indicator of improved loan quality and a healthier economy for their borrowers. And let's look at their non-accrual loans, which are loans where payments are seriously overdue. This ratio is 1.51% in September 2025, down from 1.63% at the end of 2024. That is a positive trend, meaning fewer loans are in trouble. They have some collateral-dependent loans, meaning if the borrower can't pay, the bank takes the collateral. The loan to value on these bad boys was around 104% for real real estate secured loans on the 30th of September 2025. This means the collateral is worth a bit more than the loan amount overall. This is a good sign that if they needed to seize collateral, they would likely recover their money. Looking at their expenses, they spent about $21.3 million in the third quarter, which is fairly flat. They did see a notable increase in professional services, up 22.8%. This might be for legal advice or consulting as they navigate these financial markets. They also provide non-GAAP measures, essentially adjusted numbers to give a clearer picture. The comparable return on average equity, excluding those investment losses, hit 6.79% in the third quarter. That is a solid number. This TCE ratio, which measures their capital against their assets, is a bit technical but basically shows how strong their capital position is. It is around 8.2% after accounting for hypothetical losses on investments. This is a key metric for banks to show they can withstand market shocks. Their capital ratios are well above the regulatory requirements, showing they are very safe. They have strong buffers in place to handle unexpected events. They have a very strong liquidity position with over $2 billion in readily available funding. This means they can easily meet their obligations like deposit withdrawals or loan demands without any issues. They are also actively managing their deposit rates, lowering them where possible, which helped reduce their cost of funds. Now, about risks. Like all banks, they're exposed to market risk, especially from changes in interest rates. They've got models to predict how different interest rate changes might affect their income, and their current position seems to be within their approved limits. In terms of their investments, most are rated level 2, meaning their value is based on observable market data. They have no level 3 assets, which are the trickiest because their value depends on unobservable inputs. This is a sign of a conservative investment strategy. So, what is the verdict on Bank of Marin Bancorp? They're showing real signs of recovery and strategic repositioning. The move to take a hit on investments last quarter to improve long-term profitability is starting to pay off with a return to net income in the third quarter. Their loan portfolio quality looks good with low non-accrual loans and a strong allowance for credit losses. Deposits are growing and their capital and liquidity positions are robust, exceeding regulatory requirements. The main risks seem to be tied to broader economic conditions and interest rate changes, but they appear well prepared to handle those. Overall, Bank of Marin Bancorp seems to be navigating the current economic landscape prudently and is demonstrating a path towards improved profitability. Alright, that is our breakdown of Bank of Marin Bancorp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.